Hello and welcome. This is Mike Williams with Genesis Asset Management. We are sure glad you're here with us today. If you sit back and relax a little bit, we're going to embark on a trail of information here that we think if we connect all the breadcrumbs, you're going to find a pretty exciting future lies just ahead. Before we get started, I want to let you know that we're calling this the 1982 review. There's a couple reasons for that. I don't want to bore you to death, but I started in the business in August of 1982. I was advising my first clients right after a horrible decade we called the 70s at the time. I know I'm dating myself. For those of you that are younger than I, it may take a moment or two of your time after you watch this video to go back and look at 1982 and do a little bit of research, but we're going to try to do a lot of that for you in this video. So let's kind of set some framework for you. First of all, it's my responsibility to tell you that our business is managing assets, but we also spend a great deal of time coaching clients, and you're going to understand why when you see all these pages on this video presentation. It'll make a little bit more sense as each little breadcrumb is uncovered, but I hope you'll bear with us and be patient with me. I'm not an expert video person, but we'll see what can happen here. So let's kind of think about this for a second. Before we get to the details of 1982, you probably need to know about us to help you build your confidence a little bit in who we are. Genesis, first of all, you can check all of this out. You're welcome to ring us or email us or check us out on the websites. All this can be given to you, all this data. So this isn't a sales pitch. This is more of a confirmation of a few things. We have been fortunate enough to have guided our clients in a way that we've been named top managers in the U.S. by Pension and Investments. 5 of the last 6 years, soon to be 6 of the last 6 years, because they haven't gotten the tallies yet for 2013, but I think you'll see from our results we're probably going to fall in that category 6 out of 6 years. So we've been serving clients for 30 years, as I had said. In that period of time, obviously, one can expect we've seen all of the rotten times that so many of us have created a fear mechanism around in our minds, even though sometimes we don't even know it's driving us. It's almost subconscious. But we'll go into that. So we've seen the bull and bears. We've seen the bad times. We've seen the good times. We've seen the positive. We've seen the negative. Boy, we've seen every single expert. I've been interviewed with experts. I've been on CNBC 500 times, Bloomberg a couple hundred times, Bloomberg Radio, Fox News, been on the floor of the exchange, gotten interviewed by all the fancy people on TV. Believe me, it's quite an eye-opener, but I think you'll find that through all that craziness, we're not so crazy after all, and thank God for our clients. We've been able to work together as a team and help them meet their goals. We're managers of the second best performing mutual fund in Europe. Obviously, there's a lot of mutual funds, but there aren't as many in Europe as there are in the United States. But in our class over there of unit trust mutual funds, we are 2 out of 196 for the last 3 years. That's pretty good. We're not number 1. There's a reason for that, but I'm not going to make excuses. We are not number 1. We are number 2. But we're certainly trying to be number 1 for all of our clients that are on the other side of the ocean. Obviously, our private accounts here in the United States are significant. I'm going to tell you about that. I had the great benefit. The first Genesis was merged into a wonderful firm in New York City where we managed over $10 billion. I was blessed to be partners with some brilliant investors. Learned a great deal more from them to add to my 30 years in the business and cherish those times. And fortunately, we've been able to bring some of those benefits to our clients as well. So our private accounts have, thank God, knock on wood, beaten the S&P 500 index by a pretty darn wide margin. In 2012, while the S&P was up a solid just under 12%, we beat that by a little bit. Not as much as we did in 2013, but we did pretty well. We got over 17%. You can see plenty of disclaimers. You're welcome to ask for the data. I would recommend you ask for the data. We can completely disclose all of it. Send it right over to you in a PDF form. You can read every single detail associated. In 2013, we had a wonderful marketplace. Oddly enough, far too many investors were stuck in bonds because they felt safe. We'll get to that a little bit later in the presentation, but equities, strangely enough, went up over 30% last year. Wow. I'm certain nobody thought that was going to happen on January 1st, 2013, but I think you're going to find out we did, and our clients did. So in 2013, we were fortunate enough to help our client portfolios rise by a wider margin than what the S&P 500 saw. And again, all this can be given to you in writing. You are welcome, and I would attest, please take the time to ask us so that you can build your confidence as well. The good news for us is that we only have one focus. That's all we do, is focus on our client. That's it. Lots of noise out there, lots of stuff you could read, lots of things you could be afraid of, lots of stuff that could frighten you to death and have you climb into a little hole and pull the cover over and hope it ends soon. But we just focus on our client and their interest. Our job is to coach our client while we're obviously helping them make solid investment decisions. We're really a coach often because, hey, rest assured, there will always be tough spots to coach through. I promise you, no matter who you choose as your advisor, you and your advisor, that includes us, will have periods of time where you are looking for the screwdriver to undo the windows so that you can leap out of the window from the highest floor possible while the market stinks. It will make you want to do that. In fact, many times I have had to lock up all of the screwdrivers in our offices, especially when I was in New York, because I was on a really high floor and it was nothing but asphalt below. Thankfully, our offices in Chicago are right over the river, so if I have to jump, I'll probably land in some pretty cold water, but hey, water nonetheless. So our purpose is to, no matter where you start, to help you map out a plan to get to your goals. Our job is to help you become aware of the things that you should pay attention to and the myriad of things that you should literally not spend 1 second of your life worrying about. And of course, the latter is more valuable, strangely enough, than the former. And we're going to show you why. Our value is driven by our independence. We always tell people, look, when I started in 1982, I was just young, wet behind the ears guys, and I didn't I didn't know all the stuff I didn't know, so that's probably good news. I wasn't afraid of a lot of things that I am today, and I'm 53 years old, and God, after 30 of these years, you learn to have all these fear mechanisms that you have to fight against, but that's what age does to you, I guess. But independence is important. We don't answer to Wall Street. Look, we have great friends on Wall Street. Some of the smartest people I know are on Wall Street. Unfortunately, they happen to be in an industry where there's quite a few bad apples, and I think the public has been served in a pretty bad manner, and that has damaged the trust that we fight so hard to help rebuild in the minds of our clients. We answer to one party, you. That's it. Nobody else, No other phone call can come into this office except, I guess I should probably say maybe the IRS and the SEC. We do have to answer to them, but the, the reality is in the investment world we answer to our client, you. And we kind of like it that way. We have nothing else to cloud our thoughts. But look, enough about us. Let's go back to the point of this educational process. Could we really be on the brink of what happened after 1982 again? Could we, oddly enough, as crazy as this is going to sound, and I do mean crazy. Look, I know when you're done with this video, there's a very, very strong possibility that you are going to be fairly certain that we've lost our minds. Oddly enough, you would have thought that in 1982 as well. But let me explain. Grab a cup of coffee, relax, and just for a moment, let your senses depart. Let your mechanisms that will fight off even the possibility of good news, let those go for a minute. And let's think back to what it was like then. Now again, if you happen to be beneficially younger than I, some of these things you might have to look up. But if you're 45, 50, you're going to remember it all. So what did it look like? Look, in 1982, we looked back behind us and we saw the lost decade. You remember that? You remember that because every single day now we hear fretting about the lost decade. Well, we've had one of those before, strangely enough, and it was the 70s. And right before that, it was the 60s. And everything on the horizon was dark. We just had troubles that no one could see us getting through back in 1982. Oddly enough, it was so bad that in the now infamous or famous 1980 speech right before the Winter Olympics, strangely enough, then President Carter stated unequivocally that a majority of our population now believes our best days are behind us. Now, I know that sounds odd since you and I have now lived all those days forward, and we can kind of see all the wonderful changes that took place and the massive expansion of the planet and the United States and every state in the Union that has taken place since 1982. But imagine for a moment that in 1982, the majority of our population was convinced that our best days were behind us. Why would they think that? Well, let's go over a couple of facts. Back then, the prime rate was on its way to 20.5% under Mr. Paul Volcker. He was going to break the back of inflation one way or the other, and the way you do that is you squeeze money out of circulation. You make it so expensive to do things that everybody has to think, what's the best way to do this? Because this is going to be expensive. Mortgages on homes at the time, if you were fortunate enough to be able to buy one, were 17%. Imagine that, 17%. And we get afraid today because it goes up to 4.5 instead of 4.25. Wow. Perception does change, doesn't it? Back then, inflation was out of control. Forget all the reports you hear about today with all the fancy labels and 3 or 4 digit symbols. Forget those. All that mattered in 1982 when I first began is if you weren't watching the market on Wednesday at 2 o'clock, then you missed the most important piece of information, because at 2:01 everybody on the planet knew what the growth of M2 money supply was for the previous 7 days. Why was that important? Well, like I said, inflation was out of control. That was it. Go back, read every headline. You'll find a lot of them that says inflation will eat us alive. In 1982, inflation hit 15.5%. 15.5%. Another problem we had, oil and OPEC. Remember the gas lines of the 70s? OPEC created an oil embargo. We had gas lines. Tanks were empty. If you didn't have the right last name, you didn't get gas. Headlines in 1982 told us that the United States consumer, and I'm quoting here, could not afford $1 a gallon gasoline. Now I want you to imagine for a moment that if tomorrow morning you and I woke up and gas was $1 a gallon, what do you think we'd think? You think we couldn't afford it? Or maybe we could. And then, oh boy, President Reagan arrived. Reagan arrived on the scene. Remember, he was the actor from California. Yeah, he was the governor, but he was really an actor, and not a whole lot of people believed him. And then he came up with this crazy idea called trickle-down economics. He brought in a bunch of people that were just business guys, and everybody got really mad because he thought, we ought to build business so business can hire people, so jobs can grow, and this trickle-down effect of money would move into the system and everybody would benefit. Nobody believed that, of course. Then he did the foolish thing of cutting taxes. My God, we were already in deficits and they ballooned. I mean, they went crazy. We were told by every expert, that of course wasn't President Reagan, that we would pay for this forever. We'd pay for it forever. Nothing good was going to come of it. Nothing. Within months, as you may recall, if you're my age, voters in general wanted President Reagan's head on a platter. That was it. He was out. Man, we can't afford more years of this. Sound familiar? I'm sure it does. And then this happened. What's this? Well, what you're looking at right here is a screenshot of the S&P 500 index that goes from 1961 all the way to the end of last year. Now, think about this for a second, because that green star is this 1982 period that I'm talking about. And when the market finally broke out after that summer of 1982, when I was, thank God, lucky enough to get into this industry, nobody at this green star marked on this chart thought that the next 18 years would happen, follow my cursor, like this. Basically, straight up. Now, I'm going to tell you a few things along the way so that you can kind of see that it wasn't an easy ride for every step of the way. You do remember that the market crashed in 1987. I get people to tell me, Mike, the market will crash. And I agree, the market will crash. It will crash again, as it has several times in the last 30 years. It will crash because of panic. I was there in October of 1987. I was there on Ugly Friday and Black Monday, October 19th. I made notes as the market crumbled underneath us. I watched stocks go down 80%. In the last 10 minutes of that particular day, stocks cratered because literally every single dollar that wanted to buy left. Nobody bid anything. And the panic fed on itself to the point where 22% of the stock market's value was erased in 6.5 hours. All that night, the news was splattered everywhere. No one went to sleep. No one knew if the markets would open. No one knew if banks would open. Books weren't balanced. It was disastrous. The Fed stepped in, flooded the market with liquidity, stood at the microphone and said, guys, we're going to get through this. And the very next day, the stock market opened up 200 points. And if you did not buy those stocks the last 15 minutes of October 19th, 1987, guess what? You never, ever, ever saw those prices again. Because right after that thing, look at that red star and watch my cursor, look what the market did right after that. It just went straight up again. And it kept going. Until when? Well, we did have a recession. It was the 90s. And that's where that next little red star is. You see that little dip? That was the recession. You bet. Remember, that recession was not what it looks like on that chart right now. See, what it looks like on that chart right now is this little teeny dip. Look at it. I mean, wow, that's not even really anything I should worry about, right? But if you lived in 1990 and 91 and 92, do you know what you heard about every single day? All of the banks and S&Ls that were going broke. Over what? Over bad real estate loans. Sound familiar? We've had this replay before. And we all reacted the same way. We panicked, we ran for the hills, we sold anything that looked like risk. And then it was over. But we did lose 1,500 plus banks and S&Ls. That's a lot of banks and S&Ls to lose. We saw the guys get arrested. We saw people go to jail. It was a disaster. We had empty buildings in every major city in the country. Thankfully, right before that collapse, Japan, in the last part of the 80s, if you recall, Japan was the China of our years then. Japan was the country that was going to take us over. They were, man, if you didn't learn how to speak Japanese, you weren't going to have a job by the middle 90s. Sound familiar? See, today we get told if we don't learn how to speak Chinese, we're not going to have a job in 5 years. Because, my gosh, we owe them all this money and they're just going to destroy the country. They're going to order us around pretty soon. Guess what? If you don't listen to any more of the video, I'm going to tell you that's not going to happen either. So, here we go. Look at those two red arrows. Now, you know when those two red arrows marked? This is when everybody and their brother thought there was no risk in stocks. Now, where are these marks? These marks are the top of the tech bubble. Of course, you remember year 2000, right? And this next mark is the top of the real estate bubble. Both of those periods of time, there was absolutely no chance on the horizon that bad things would happen if you asked the mass audience of investors. It wasn't going to happen. They were flooding the market with equity risk. They were buying any dip. They were quitting their jobs to get online accounts and stare at computer screens like we do, because all they had to do is buy some stocks and they could retire. That was what they thought right here. Follow the cursor. And then what they thought right here by the 06-07 period is they didn't really need stocks as much as they had to have real estate. Man, all you needed was 8 or 10 rental homes and you just kept flipping them because they always go up, right? Real estate always goes up. Never goes down. Never in the history of the United States, right before it went down 30%, had it ever gone down. And of course, people that couldn't afford things were getting awarded hundreds and hundreds of thousands of dollars worth of debt to buy homes. So we all know what happened then, but let's talk about the psychology that we can learn from this. You see, everybody was terrified down here. They were terrified after October 1987. They were terrified in the recession of the 90s. But way up here, they loved stocks. They loved them. You couldn't pry tech stocks out of dead hands in March of 2000. In fact, strangely enough, you couldn't pry them out of those hands until these green arrows arrived. And what do you know? You see, in the green arrows, the very same public that was illustriously enamored with stocks and risk at those red arrows on that previous screen, those very same people did not want anything to do with stocks at these green arrows. Now, structurally, I'm going to compare some of these times to you, but right now I'm just trying to get us to understand this is the madness of crowds. This is the madness of those emotions that will tear at you as an investor at the precise times you don't want them to, and quite honestly, going forward, you can't afford them to. And that's our job. Our job is to help our clients understand when that is and to be planning for those events so we don't panic, so we don't let those almost uncontrollable human nature events take over at exactly the wrong time. So I want to point out a couple of things. We've gone over periods and we've talked about them philosophically and we've talked about the emotions, but what do they look like? You see, I like looking at things. Now, some people like reading, some people like listening. I get bored if I read. I gotta read, but man, do I get bored. I'd rather be able to listen and make this stuff move around and see pictures of it. But these are fascinating pictures to me. I want to explain to you why. You see, this is that ugly lost decade before the 82 secular bull market that went on for 18 years. This is the lost decade, right? And look what this is. This is the lost decade. Now I want you to find here that some interesting things happen. Notice this first collapse in the previous lost decade. That was in the early 70s. And then it rallied back. You see how it rallied back? And then it collapsed again in the mid 70s. But it undercut that first collapse by just a little. It washed everybody out. We call them running stops. It took everybody out. So everybody was a loser. And then it stopped. And look what happened here. Now in the year 2000, we obviously had the tech bubble collapse. And then we went back up to another rally just like this. You see that? We beat it by a little bit just like that. And then we collapsed. And we took that low out just a little bit, right exactly, near exactly percentage-wise, what we did in the 70s. Then it took 7 years to come back. Now it's taken 5.5 to 6 years to come back. Does any of that sound familiar? See, that structurally tells us that the same things that were going on in the 70s that no one talked about have been going on in the last 10 or 12 years too. You know what that is? That's stuff that no one ever speaks of. It is the lessons that are learned. We talk about the fear, but we don't talk about the lessons. You see, while everybody's afraid, companies were afraid too. Managers were afraid. Employees were afraid. If you weren't bolted down to the hardwood floor in the year 2008, you got fired. If you weren't absolutely necessary to open the doors the next day, you got fired. You were extricated from the process. What did we do though? What did companies do when that much pain happens? Let me tell you what they did. They did exactly what they did in the 70s. They learned how to do more with less. They learned how to control expenses. They learned how to come up with more creative ways to accomplish things. They exploded in productivity. What did that mean to the bottom line? Their financial statements got better. Their cash levels got better. Their cash flow got better. Their margins got better. And guess what? Their profits got better. The profits got so much better that they were able to expand. And look what happened. Follow the cursor. 1982 was not the end of the world after all. It was the beginning. Well, we kind of think we're on that same precipice again. And these pictures are designed to help you see beyond. Now, granted, I understand this is a little crystal ballish. We're certainly, if you follow our notes long enough, you'll realize we hate crystal balls just like everybody else because we know they don't work. But the fact is that we've witnessed this before. So what have we learned in the last 30 years? After all this mishmash and all these things to be afraid of, here's what we learned. We learned that investors, even smart ones, feel better after stocks rise. Oddly enough, the future looks more clear after stocks rise. Now I want you to remember that. The future looks more clear because that's a really funny joke we play on ourselves. I'm going to tell you more about that in a minute. We also learned that they feel absolutely horrible. They are petrified after stocks fall. Remember those green and red arrows on that chart? After they fell, they hated them. But when they were rallying, they loved them. I hate to tell you this, but investors sell And you may have done this before. I know, look, everything I'm talking about here, we make some of these same mistakes. The good news is we make less of them than everyone else, hopefully, most of the time. But investors have this tendency to sell what isn't working. That's how they make this excuse in their mind. It's not working. Mike, that's not working. Let's get rid of it. What do you think it means when they think it's not working? Well, it's already gone down. The price has already gone down. So they sell low. And what do they do with it? Well, they take all that money and they buy what is working. Well, what do you think? Think in your mind. If you defined, hey, Mike, this stock is working, or this mutual fund, or this ETF, or this XYZ is working, what do you think that means? What picture do you think you're looking at when your brain yells at you, hey, Joe, that's working. You should buy that because that other crap wasn't working. That's why you sold it. Remember? But what do you think what is working means? It means it's already gone up. In other words, we buy high, right, and sell low. Now, if we learn anything in this video, those last two comments, buy high and sell low, will not get you to your wealth building goals. That I can tell you as a fact. Very little else about the future can I tell you as a fact. But that is. So, here's the really scary part that you learn as an institutional thinker. Without all the emotion, as bad as it feels, risk has generally been reduced after stocks fall. Now, I know that's backward and it feels awful weird, but I promise you, the flip side of that coin is that risk has actually tended to increase after stocks rise. So right when everybody starts feeling good, the risk is actually higher. And when they feel absolutely terrible, the risk is actually lower. Now, it's backward. I get it. I understand. Believe me, I fight the backward thing all the time. I know how you feel. Promise you. Don't fret, because everybody feels the same way. So you're not crazy. So the question is, how in the world could today be 1982 all over again? Well, first of all, let me say this again. I know that this is going to sound nutty, but bear with me if you will. Just let your senses go just for a second. So why would it be like 19? Well, look, I'm sure we could all say today, man, the future looks pretty dark. You see, when things are being feared, strangely enough, the future looks cloudy. I love that comment. Future, Bob, I'm not going to buy stocks because the future looks cloudy. But I promise you that very same emotion will change after stocks rise. And you know why they'll change? Because the future looks more clear. Listen, if you find yourself playing that mental game, please extricate yourself from investing in anything because you're not thinking clearly. Nothing about the future changes its cloudiness level ever because we don't know what the future is. We only feel different about the future, so we have our mind playing this game on us that it's like putting anesthesia on our brain. As the markets skyrocket, that anesthesia goes to work, and what it does is it somehow makes us nutty, and we think, oh, there's no more risk. There's no more risk, and the future looks so clear that I'm going to roll the dice. And that anesthesia wears off as those stocks sell off and everyone panics. It wears off and we become experts at risk and understanding everywhere that it is. We got dark horizons. Man, have we got problems today? Sure, we got problems. We got as many problems today as we had in 1982. Only you know what? And here's the big one. You're always going to hear this. It's never been this bad, Mike. Well, I promise you it has, but I will guarantee you, you will get told that many times at your cocktail parties. Oh, no, I can't take equity risk because it's never been this bad. Man, we got problems. What problems? Well, everywhere you look, there's Armageddon headlines. I mean, there's risk everywhere. Look, we're $17 trillion in debt. The United States owes everybody, right? We're going to talk about that in another video, but do you really think we're $17 trillion in debt? I'm going to give you a little teeny hint. We have assets that are about 10 to 15 times that level. So we're really not going to lose our shirt. But, like I said, that's another. We've got massive unemployment, right? We get told that everywhere. We got breadlines, just short of breadlines. We got more people on the social handout programs than we've had ever. That's what we're told, right? There's no good jobs, ever, again, certainly. Manufacturing's dead, right? All those jobs are gone. They're gone and they're never coming back. We've heard 1,000 times that we have this odd thing called a lost decade. The markets went nowhere for 12 years. They just went back and forth, chopped themselves in half. Two horrendous bear markets in a 10-year period. People are dizzy from the roller coaster ride. And they've sworn off equities forever because you know why? Bonds are safe. Bonds are safe. Come on, really, seriously, bonds are safe. That's what they're now telling each other. But you remember the pigs, right? Greece. All the things that were going to destroy us from Europe. Remember, it was just a cyclone of events. Greece was going broke. Spain was going broke. Italy was, Portugal, all those places. Europe was collapsing around our ears, and it was going to take us with them. You remember, right? Remember that? Of course, you got to be afraid of that, right? Terrified. The fiscal cliff, that was all the fiscal cliff was, first of all, not even a term when 2012 began. Nobody even said those words together. And by the end of 2012, and the reason most people missed that huge gain in 2013 is because the year 2013 started with the fiscal cliff. And we were all going to go off of it, remember? The economy was going to collapse because of the fiscal cliff. Or how about QE1 or 2 or 3? Oh my God, we printed money till it was coming out of our ears, right? It's worthless now. Inflation is going to eat us alive, and all you had to do was buy gold. Except that didn't work. The debt ceiling, you remember that? The debt ceiling fight in D.C., remember how collapsed the market felt in the summer of 2012? Oddly enough, by October 2012, we wrote a morning note to our clients and said, we do have a big fear after this debt ceiling fight caused that big summer swoon that everybody is convinced will happen every summer. But there was a summer swoon in 2012, and it was all about the debt ceiling fight and the downgrade of the United States debt market. Remember, that was going to collapse us too. Except, you know what we told clients in October of 2012? We said, we have a fear, but our big fear is that we're going to soon come to a time when there's no more corrections in the market that we can take advantage of. When there's no more times when the market will panic so that we can buy things valuably for our clients. That was our fear. But what about the next debt ceiling fight? Well, that's coming up. That's coming up, right? Right as this video is being done, we're on the brink of having another debt ceiling fight. How about all those tax increases on the rich in 2013? How about all those bills that we thought were going to collapse the crisis in the consumer market? Gas bills went up, everything went up, and the consumer was not going to be able to afford it. But guess what? We did. We set records. It's a funny thing, you know, in the United States, when we feel bad, you know what we do? We go to the mall. Well, how about the healthcare crisis? We can't forget that, right? The healthcare crisis is upon us. That's going to collapse the economy. And of course, right after that, the Medicare crisis. I mean, I can't keep track of all these crisis things. Social Security crisis. Hey, look, if you think we're out of crisis to worry about, think again, my friend, because we have a lot of them. Wall of worry. Hey, markets love to climb walls of worry. I would attest to you that we have a mountain of worry, not wall. We have a mountain, and it's a big mountain. We've spent the last 5 years running from apocalypse now, and it just fill in the blank of what was going to cause it, to apocalypse later. But all the while, the wall of worry's been there, except the market has doubled. Have your assets doubled? Here's the thing about walls of worry. I was told when I was 21 by a really smart guy at a very large firm on Wall Street, hey, Mike, elephants never bite you on the ass. Mosquitoes do that. Took me a little while to figure out what he meant, but here's what I learned. What I learned is all the crap that we worry about isn't what actually ends up causing the problems that we then worry about. It's all the stuff we don't worry about. It's the stuff we're not looking for. It's the left field item. It's the item that comes out of nowhere. So why are we spending all our time worrying about the same stuff we've worried about forever? We've worried about the same stuff for 5 years. 5 years we have worried about everything that we already know about. So think about this for a second. What if you and I sat down and had a cup of coffee in August of 1982 with all the problems that existed at the time, and I said, hey, look, Jack, I know how bad the news is, but I'm going to tell you something really crazy. I know this is going to sound crazy. The market, the Dow, that's right now less than 1,000, is going to hit 15,000 30 years from now. 15,000 in 30 years. Now, I'm going to give you a second to stop laughing and then ask yourself this question. How crazy do you think, A, that would have seemed, and B, I would have been? Because believe me, I got told I was crazy. I got told I was crazy a lot. And the other thing I got told was, Mike, you're young. Yeah, that was a nice way of saying you don't know what the hell you're doing yet. But let me tell you something, young man. It's never been this bad. Now, we have a whole nother video lesson about those 5 expensive words. We call them the 5 most expensive words in investing. It's never been this bad. More on that later. But how crazy do you think I would have been? Seriously. 15 times higher than it was in 1982? With all the problems we've lived through? I mean, how many things have we lived through in the last 30 years? I mean, think of how dark the horizon was in 1982 with all those problems we faced, just like today. Every single thing investors are afraid of today, including you and I, has happened in those very same 30 years. Every fear that is now locked into our minds has unfolded already. And here's the really sad part about this. They all unfolded at lower prices. So our cost has not been the market. It's been our reaction to the market. The market has gone up 15 times while all that horrible stuff was unfolding. It is our reaction to the stuff that has caused our position in life. Think about that. All those terrible things, every event you can think of, and the markets have gone up 15 times since 1982. Now here's the really, really weird part of this video. Now, I'm going to ask you to think for a moment before you react. Were we sitting together today, you and I grabbed that same cup, well, maybe not the same cup of coffee, but grabbed a cup of coffee again. Here's what I would say to you. The next 30 years are very likely to look a whole lot like the last 30 years. I know that sounds like I'm calling the future, but life unfolds in general terms. And as nutty as it would have sounded in '82 to tell you that, it's going to sound just as nutty to say it today. Many terrible things are still going to happen to us. Lots of them. I can promise you. We will be able to count on more wars, more things we don't agree with, more geopolitical disasters, natural disasters, horrible events will befall human nature. Guarantee more recessions. I promise you there's more coming. And growth cycles will follow each of those recessions. There's going to be market crashes. Promise there'll be market crashes. There's going to be events that will cause bull and bear markets. They will come. Do not doubt that. Yet if we have the very same type of things unfold in the next 30 years, and we witness the same results, as much of a whirlwind as it's going to sound like, it would take the Dow to over 200,000 30 years from now. 200,000. I know. I look, before before the laughter gets too far out of the way, I know what you're thinking. Okay? You're thinking, how crazy is that? How crazy is that? It's the craziest thing you can imagine possible. I know. It's as crazy as it would have sounded before, but think, is it crazier? I know. How crazy was it then? Seriously. Compare those two elements. And then realize this, it's during the greatest periods of risk and perceived dark horizons that we actually find the greatest opportunities. It's the things that people aren't looking for. It's when everyone is a funk. The dark clouds mask the future. Problems are around every corner that we find the lows in prices and the highs in value. Remember, we talked about it. What is working and what isn't working. You reach those peaks. Risk is dynamically altered by time. Think about that for a second. If I have a goal which demands capital in 6 months, if it demands capital in 6 months, what the heck am I risking things for? Because my perception of risk changes daily. I can't have that money at risk if I need it in 6 months. That's just proper planning. I can't afford to skip a beat. So there are certain areas of your capital structure that should be at risk and certain things that shouldn't be. But here's the one thing you need to realize about risk. If you don't take risk, you don't get return. I know that sounds like German, but I promise you, no matter what you do to invest for the future with the intent to make a gain from that investment, I promise you, you are taking risk. I promise. There is no way around it. However, if we have a wealth management plan that maps out goals in proper time frames, then there's much of your capital and your perception of risk will change. You will change your perspective because it positions you as the predator, if you don't mind me using that term. It permits you to act when others will all fear. They will fear when things go down. Your proper plan will allow you to take advantage of that quote-unquote risk while most fear. Your wealth plan can expand, oddly enough, during the very same times other investors will freeze. You remember those green arrows on that map and the red ones? Remember how they were attached to the wrong psychology? So look, this is kind of an introduction of us to you, and we hope it's been effective. We're gonna try to add more value in the weeks ahead for those who choose to accept it. We've created a little top 10 list. Doesn't mean it's the best 10. It's just a good 10 list of stocks. If you would like to have a copy of what our insights are after this video is done, let us know your email and a way to contact you, and we will be happy to send it along. Now, I know, Mike, what are you going to do that? Well, it's our way of trying to rebuild or build trust. Um, the rebuilding process is understandable for most investors because of the horrible loss of trust over the last decade or two, or so, I should say, probably 10 to 12 years of garbage in the markets. Entire sections of the investor audience has left the market because they don't trust it. And I can understand why. But there's a word that we like to throw out to people because it kind of jars your thinking. The word is participate. And the question is, will you participate? Now, I know you're wondering, what do you want me to participate in, Mike? Will you participate in the end of the world or not? Think about that. You get to choose. Will you participate in the end of the world and stay focused on that because you can, or not? Our view is the markets are like a good college. You know how college works, right? You go to school and learn things. The difference is that in the markets college, you can take the same class as many times as you want. As many times as you want, and you can spend as much as you want to learn that lesson. I promise the market won't care. It'll take all your money. And nobody will wake up the next day and feel bad. Don't let the lessons of the latest lost decade go to waste. There's too much that's been learned. There's too much value to come from that lost decade. We're confident, in fact, that some of the greatest opportunities of our lifetimes are just ahead over the next 10 to 15 years. Incredible events will unfold, but only for those who are prepared, focused, disciplined, and they're all about staying focused on following their plan and not their emotions. Because, see, emotions are critical. The coaching process is critical. That's why we've tried to define it so much for 30 years. Independence is critical. The whole world of opportunity is out there. Staying on your path is the key without being controlled by the emotions. So look, we hope you've enjoyed this overview. Like I started, I know it sounds crazy, but it sounded just as crazy in '82. Our hope is that we're able over time to earn your trust. Make sure you provide us that email, as there's much more to come. And one more thing, we like to tell everybody this. If you have any questions, you want a confidential review, you want to talk about your goals, or anything on this video, anything, dial us direct, 312-957-2400. You can visit us on the web. You can send us an email if you like. If you want to stay confidential and just send us an email, we'll be happy to answer. info@genesisam.com. Remember this, the only bad question is the one you don't ask. Thanks a bunch for your time. I am so grateful that you took a few minutes to spend with us. We really appreciate it.